All right, welcome to The Explainer. Look, every serious investor has been there. You build what feels like a perfect model, but then the real world just refuses to follow your script. So today, we're unlocking a professional grade tool to help you master that uncertainty. It's called scenario analysis. And this is how you stop just predicting and start actually preparing. So, you've put in the hours, right? You've built your model, and it spits out this single, beautiful number. 2,000 rupees. It feels so certain, so precise. But what if your growth assumptions are just a little too optimistic? What if a new competitor, just pops up out of nowhere? What if a recession hits? What then? And that right there, that's the danger. It's what we call false precision. When you rely on that one single number, it creates this dangerous illusion of confidence. Because let's be real, the future almost never unfolds exactly the way we think it will. This belief in one specific outcome, well, it's a trap that trips up even the smartest people. Okay, so let's dig into this idea, this single point trap. We're going to break down exactly why hanging all your hopes on one perfect number is such a flawed way to make really important financial decisions. So, what's the antidote to this trap? It's scenario analysis. And really, it's a fundamental shift in how you think. You stop trying to predict the single right answer, and you start preparing for multiple different futures. It's all about exploring a whole range of what could happen, not just fixating on one single point. So, this gets us to thinking in scenarios. This is how the pros do it. Let's explore how they use this exact technique to look at both risk and opportunity in a much more sophisticated way. The classic way to do this starts with three core scenarios. First, you've got your optimistic case. This is your blue sky scenario where everything just goes perfectly. We're talking higher growth, better margins, the whole shebang. Then there's the realistic case, which is your base expectation, what you think is most likely. And finally, and this is so important, the pessimistic case. What happens when things go wrong? All right, enough theory. Let's make this tangible. We're going to walk through a really practical example. We'll use a hypothetical company we're going to call GrowthMart. Now check this out. Just see what a huge difference a few key assumptions can make. For our company, GrowthMart, in the optimistic case, we're assuming this really aggressive 35% revenue growth. But in our pessimistic case, we dial that way back to just 15%, and we assume margins get squeezed. And just like that, you've got two completely different futures for the exact same company. And boom! Look what this does to our valuation. Instead of one number, we get a whole range of possibilities. The pessimistic case values the stock at 950 rupees, the realistic at 1,800, and the optimistic at a whopping 2,850. Now, we've also assigned probabilities to these. Our research suggests a 50% chance for the realistic case, 30% for the optimistic, and 20% for the downside. This isn't just one data point anymore. It's a strategic map of what's possible. Okay, so we have this range, but how do you turn that into a single number you can actually use to make a decision? Well, that's where we calculate what's called the probability-weighted expected value. And the process is actually pretty straightforward. You just multiply each scenario's value by the probability you assign to it, and then you add them all up. Let's do the math step by step. We'll start with the optimistic outcome. So the blue sky valuation is 2,850 rupees, but we think there's only about a 30% chance of that actually happening. So the weighted value from this scenario is 855 rupees. All right, next up is our realistic case. This is kind of the anchor of our whole valuation, right? It's the most likely outcome. We give this 1,800 rupee valuation a 50% probability, which contributes another 900 rupees to our total. And last, but definitely not least, and you cannot skip this part, we have to factor in the downside. That pessimistic value of 950 rupees has a 20% chance of happening. So, waiting for that risk adds the final 190 rupees to our calculation. You add those three numbers up, and there it is, our total expected value, 1,945 rupees. Now here's the key. Remember our original guess of 2,000? This new number is close, yeah, but it is so much more robust. It's not a guess anymore. It's a thoughtful valuation that has already baked in both the potential for things to go great and the risk of things going wrong.
Okay, this is the moment of truth. This is where the rubber meets the road. The stock is currently trading at 1,200 rupees. Our calculated expected value is 1945. That gives us a potential upside of 62%. But, and this is a big but, we are also clear-eyed about the risk, a potential 21% loss if our worst case happens. Now you can make a real decision, not based on hope, but with a clear view of the risk versus the reward.
So what's the big takeaway here? It's that this whole process, it gets you to a much smarter way of investing with uncertainty. The real power isn't just about getting a better number. It's about changing your entire mindset from trying to predict the future to actually preparing for it. Now, hold on. Before you run off and do this, there are a few classic mistakes you absolutely have to avoid. First, don't make your best and worst cases too safe or narrow. Second, make sure your assumptions are consistent. You can't have high growth without high investment, right? Third, remember your probabilities are educated guesses. They're not gospel. And finally, don't forget that these things are often connected. A recession doesn't just hit growth, it hits stock multiples too. You know, it all boils down to this one idea, and it's captured perfectly in this quote. It's better to be roughly right about multiple scenarios than precisely wrong about one scenario. That is the mindset of a professional. So I'll leave you with this question. Are you still stuck betting on one single future? Or are you ready to start preparing for what's really possible?